Welcome to Market Intel. We're building on our previous volatility videos on volatility regimes, and this week I'm looking at compression and expansion periods on their own with a different question this time. Does understanding the volatility environment improve our decision quality, even when price direction is uncertain? Just to be clear, this isn't financial advice, and I'm not a financial advisor. What I looked at is, I took that volatility regime framework and kind of chunked it up into compression periods in the blue here and expansion periods in the green. And I've used a slightly different definition of expansion and compression intentionally because we're asking a different question, and the question shouldn't serve the definition should serve the question. And so because we're focusing on decision making and behavior within regimes, I'm using a expansion definition as any time the BBWP gets above the MA, and compression is any time that the BBWP gets below its MA. And I'm using these settings, same as last time, with an SMA of 6. For each of these periods, I just measured a few things like the duration, the price change from close to close, and the outcome distribution. And I also looked at momentum in relation to this, specifically what direction the stochastic was pointing at the beginning of each of these phases. And I mean, if it's up, that means the K orange line is above the D blue line. And the overall goal is to compare these different these periods, these environments, and find out which are more or less favorable and how maybe our decisions might change in these different environments. And the obvious reality at the start is Bitcoin goes up and to the right. Doesn't matter how you cut it. Any of these regimes, most of the time, will be going up and to the right. And it matters because it changes the default mistake that people make. It's not about being too optimistic. It's about timing. And the common trap timing is getting into this market when expansion has already begun, and the hype is high and the prices are moving fast. And I think this can be kind of exemplified by the fear and greed index here. Um, you can see, if I get rid of the stochastic as well, you can see that this period here is very high BBWP, very high volatility, and it's also high in the greed, which means that lots of people are buying and thinking that it's going to go to the moon. But if you were to buy here towards the top of the BBWP in a high extreme greed, you're not actually going to be getting that good of a return for the next sort of 3 years. In fact, you're going to experience quite a lot of losses. And I think that is the common mistake that people make, is that they get in during these periods of hype, and then price slows down, the movement dries up as volatility drops, attention fades, and confidence drops, and the price goes with it. And the natural reaction, we're all human, is think, okay, I'm losing money, I don't want to lose any more money, and then you reduce your exposure. And that's not to say that these compression periods are inherently bearish. They're not, and they're certainly not unproductive. But what changes is the risk profile. There's a key difference between these expansion periods and these compression periods. In expansion, it's less variable. It's a bit more stable distribution, whereas in the compression periods, there's a higher variance, there's a wider outcome range, and there are deeper drawdowns, which is why it's difficult. Compression isn't inherently bearish, it's just a little bit more emotionally uncomfortable. So for people who buy in at the top here, towards the top of these expansion periods where price is high, they then almost immediately get thrown into the most uncomfortable conditions for Bitcoin, or at least where the potential for uncomfortable conditions is highest. So layering momentum on top of this has been relatively useful in one way, positive expansions. So essentially, when volatility expands in this definition of BBWP closing above the MA, the observed outcome is that approximately 80% of the time, if the stochastic is pointing up, then the expansion resolves up. And you can measure that in a couple different ways, whether it's compared to the number of up calls, the number of times that stochastic has called an upside expansion, and compared to the total number of expansions, and both ways is 80%. It just happened to fall on the same number, but that shows really good consistency in the data. And so, it's otherwise unreliable in different environments, but in terms of positive expansions, when it's saying that, momentum is up and we're going into an expansion, it's a reliable tool. But otherwise, it's not good for a general signal. It's only really good for these confirmations that these expansions are going to go to the upside. And this is just an important caveat that, I'm not looking at a trading strategy here. I'm more of a long-term investor. I'm a long-term holder. And so the way I'm looking at this is in terms of exposure and not prediction. So the raw outcomes are, like all the expansion phases um, put together have about a 77% chance to resolve to the upside. The returns are more stable and there's a lower variance. So, they are not as wild in their returns as compression phases, which are also, they're often positive. There's a slightly lower percent chance of a compression phase being positive. I think it's in the 60s, but the outcomes are wider. You have more potential of downsides in compression, but you also have potential for upside in compression as well. Like the period here where we hit into $100,000 for the first time, that all came inside, a relatively compressed period on the monthly. And I did a simple experiment, and on just, with the data on paper, I bought every start of every phase, just and with 100% equity, and I sold at the end of every phase, and just to see what the results are. And historically, if you buy and sell at the start of every expansion phase, you would be better off than buying and selling at the start and end of every compression phase. Now, I'm not trying to say that you shouldn't buy during compression phases, but they're just not as profitable. They're riskier. So, I think the practical takeaway is that higher exposure makes more sense during expansion phases, or at least at the beginning of an expansion phase, and then decrease during the compression phase because the potential for downside is higher. It's not about timing it perfectly, it's just about matching your exposure to the environment that you're in. And I think that the real key asymmetry is that if you're not exposed to Bitcoin during an expansion phase, then you're really going to miss out. And if you're only exposed after the hype during these compression phases and then you buy, you're not going to have a good time. So to the current environment where we are right now, and what it implies is that we're still in a compression phase. We're still in like a bit of uncertainty. There's a higher variance of what might happen, and momentum is currently to the downside. Now, we are looking like we're going to close above the BBWP soon. The average is as low as it's been for, over 5 years now. So I think that expansion is likely in the near future, as I've gone over in the last few videos. We're looking at maybe a 6 to 12 month time frame, maybe more, but that's what I'm leaning towards. And although momentum is misaligned, expansions have historically been to the upside. So, I'll be keeping that in mind for when, the period does change, and I will, apply my own rules to that. I guess the key closing ideas are that volatility doesn't give you any answers, it actually just gives you context. It doesn't remove the uncertainty, it just reduces decision errors. And in uncertain markets, avoiding the wrong decision is more valuable than perfect timing. I think that'll do for today. I hope you found this very useful. If you like these macro Bitcoin videos, feel free to like and subscribe for more, and I'll see you next time.